We begin with some breaking news concerning the financial future of football in this country. Our City editor, Mark Kleiman, has the story. Mark.
Yes, Ian, some important news this morning about the future of English football's finances. What I understand is that the Premier League has convened an emergency meeting of its 20 club shareholders to take place on February the 29th in order to try and make progress towards a landmark financial settlement with their 72 English Football League lower league counterparts. Now, you'll recall, Ian, that the talks about the so-called New Deal have been dragging on for many months. This will cost Premier League clubs between about £835 million and £920 million over a period of 6 years, with those figures still to be ratified. And this New Deal has been put to a vote of Premier League clubs on a number of occasions, only to see it not supported by the requisite number of clubs. We're talking about clubs, of course, including Aston Villa, Everton, Liverpool and Manchester City. Now, there is a further meeting that the Premier League has convened for March the 11th in case next week's summit of the top clubs does not make sufficient progress towards the New Deal. And the reason that this timing is so important, Ian, is because Lucy Fraser, the Culture Secretary, intends to publish the Football Governance Bill around the end of this month, and that will pave the way for the establishment for the first time of an independent football regulator that will have powers to impose this financial settlement on the Premier League for many years to come. So, important breaking news this morning about the future finances of English football.
OK, Mark, thanks for that. Now, shares of Barclays have surged by as much as 7% this morning after it unveiled plans to return £10 billion to shareholders between 2024 and 2026. The news came as Barclays announced a major reorganisation involving the breakup of its corporate and investment bank and its payments business. Barclays, which cut 5,000 jobs last year, has refused to rule out more redundancies. Well, Barclays was reporting a full-year pre-tax profit of £6.6 billion for 2023. That's down 3% on 2022, but in line with market expectations. Well, joining me now is Jerry Delmissier, former founding partner of Copper Street Capital and previously Chief Operating Officer at Barclays. Jerry, great to see you this morning. And, of course...
Morning, Ian. Great to be here.
You were also co-head of the corporate and investment bank.
I was indeed, yes.
What's your reaction to it being broken up?
Well, you know, I suppose it's not as momentous as it sounds. There are two different activities. One is more global, the investment bank, than the other, the corporate bank, which is really heavily skewed to the UK. So it's a natural decision to take.
He's been quite clear, the CEO, Mr. Venkat, that he wants to reduce dependence on debt capital markets and on the US in particular. I mean, that essentially means growing equity capital markets. Is that going to be possible for a bank like Barclays?
Well, I think equity capital markets outside of the US is a very, very tough business. You know, if you cast your mind back to the days after the financial crisis, when, in fact, Lehman Brothers had been acquired in the US, we all thought that we'd see an exodus of European banks, that the stress that many of the European banks were under would lead to the creation of capital markets, debt capital markets in Europe and equity capital markets as well. That hasn't materialized. In fact, as a result of so much central bank intervention, banks kept lending and credit margins were very, very tight for so many years that I think it's choked the capital markets potential here in Europe. And I just don't see it as a viable business, not just for Barclays, but just the whole notion of European capital markets, equity capital markets, I think is a very, very small profit pool compared to the US.
And that's pretty extraordinary. I mean, of course, this was the business that you and Bob Diamond and Rich Ritchie built. I mean, Barclays is really the only alternative globally to the big US bulge bracket banks.
That's right. But since that time, I think we've seen the US banks just really separate themselves from everyone else. And of course, in the last 10, 12 years, Barclays has been has gone through some restructurings and has de-emphasized businesses only, I think, to try to get back in 21. I think there was some bad decisions, not just, again, at Barclays, but a number of European players to misread the SPAC bubble of 2021 as somehow, this was the emergence of a European equity market that, could support a business. And I think that was flawed. And I think now you've got the Americans up here and the rest
down there,
really scrambling for small bits of business that I don't think, candidly, makes any sense.
Are you saying then, Jerry, that it would make industrial logic for Barclays to divest itself of this business?
Well, divest means an awful lot of things. And I think you have to look at the U.S., where they still have some scale. I think the market presence isn't the same as it was 15 or 12, 13 years ago, versus Europe, which is really in and of itself is not a particularly attractive business. So cast your mind now forward and looking at all this capital that's going to be repaid to shareholders. I think a lot of that has to come from cost savings. Yeah. And this would be a place that I would be looking very hard.
I mean, the cost-income ratio is currently 67%. I think now Venkat said he wants to bring it down to 63. By comparison, HSBC, Lloyds, NatWest, they're all below 50. It is an investment bank that has the cost base. Absolutely. And, again, the basic premise for how the market was supposed to have evolved in the wake of the financial crisis hasn't really played itself out that way. So how long do you continue waiting and investing in the development of a business that I think has a very naturally small profit pool to begin with? Jerry, what about current deal flow? Do you see it picking up this year?
I think you'll see a pickup in deal flow. It's very natural after the big interest rate hike cycle that we saw in 22, that 23 was a year of consolidation. Now, whether or not we see lower rates, and I suspect in Europe we will, the market has adjusted to this new environment. There's a lot of dry powder among the financial community. There's a real desire to kind of get back. And so I don't think it's going to be a vintage year from a deal perspective, but I think it'll be an improvement on last year.
Now, Barclays is targeting a return on tangible equity of 12% by 2026, up from 10.6% in 2023. How do you rate its chances?
I think it's a tall order, and it's not going to, I think, get a lot of help from the top line. So it comes down to how aggressively can you manage the cost, and then, hopefully get some share buybacks done and reduce that capital base a little bit, avoid any icebergs that might be out there. And it's a stretch. It can be done, but I think the key is deliver every quarter now. I think shareholders who have long suffering in the UK banks will need to see milestones on a regular basis rather than, we'll get there in 26.
OK, Jerry, we have to leave it there. It's great to have you on the programme this morning. Come and see us again.
Thank you very much, Ian.
Got some breaking news to bring you now. We're being told by the police that a body has been recovered from the River Thames, which is linked to the Clapham attack. Detectives leading the hunt for Abdul Azidi, who's wanted for a brutal attack on a mother and her children in Clapham, believe his body has been recovered from the river. We can speak now to our crime correspondent, Martin Brunt, who has more on this. Martin, do we think it's him?
The police, well, they've announced that they found a body that they believe is him. I'm just looking at what the Metropolitan Police have just put out. So yesterday afternoon, around 4 o'clock, the crew of a passing boat reported that they'd seen a body in the river near Tower Pier. So that's in East London, or on the edge of the city. The body was recovered and has been looked at by the detectives working on the case. There's a brief comment from Commander John Saville, who's overseeing the operation looking for Yazidi. He says that based on distinctive clothing he was wearing at the time of the attack and the property found on his body, we strongly believe that it is Yazidi's body. So there's no formal identification, but the fact that the police are saying so much, the fact that they've contacted his family to pass on this news, suggests, as they say, strongly believe that it is his body. Formal identification, they say, is not going to be possible visually, nor from fingerprints, and that's really a measure of how long his body has been in the water since that night when police believe he jumped from Chelsea Bridge, which was where he kind of disappeared off the CCTV cameras that police had used to track his movements that night, several hours after the alkali chemical attack on a woman who we believe he was in a relationship with and her 2 children. The police go on to say that the woman victim, his woman victim, who was 30, is 31, her condition has improved. She's still in hospital in a stable condition and no longer sedated. So if there is some good news as this story continues, it's that his principal victim is recovering.
Martin, when the police said that they believed Yazidi had jumped into the river, they said at the time they weren't expecting to find his remains for quite some time. Is it a bit of a surprise that he's turned up this early?
I think they'll be relieved that they found him so quickly. Mark, Ian, the number of bodies that emerge from the Thames, it can be up to 50 a year. But there are others that get snagged under the water, get caught up in all sorts of things, or indeed some that are thought to go all the way out to the river estuary. So I think the fear was that they wouldn't find his body. They may be surprised that it's turned up so quickly, but it seems that their own searches hadn't been able to find him. But he was, this body that they now believe is him, was spotted by a passing boat yesterday afternoon. So I suppose this is a story that's had so much wide publicity that anybody on a boat on the Thames in the past 2 or 3 weeks perhaps would have been aware of the possibility of seeing a body, and that appears to have been exactly what's happened.
OK, thanks, Martin. Some other business news stories for you now. And the post-pandemic boom in travel has helped intercontinental hotels to record profits. The owner of the Holiday Inn and Crowne Plaza hotel chains reported an operating profit of $1.066 billion for 2023, up 70% on 2022, reflecting higher occupancy rates and higher room rates, as well as the impact of 275 hotel openings during the year. IHG, which was operating 946,000 rooms across 6,363 hotels at the end of last year, is planning to open 297,000 rooms in 2,016 hotels in coming years. The shares are currently ahead by just over 3%. The US consumer bank Capital One is to buy credit card issuer Discover Financial Services for $35.3 billion. The deal will create America's 6th largest bank by assets and one of its biggest issuers of credit cards. Discover was founded in 1985 by the department store giant Sears, which at the time was the US's biggest retailer. One of the few competitors to Visa and MasterCard in the US, it has changed hands a number of times since, most recently in 2007, when its former owner Morgan Stanley demerged it as a standalone business. Well, stocks in the Asia-Pacific region had a mixed session overnight. Hong Kong and Shanghai both finished higher after China cut a benchmark reference rate for mortgages by a record amount. Well, in Europe, stocks are trading largely to the downside. Well, look at that. They're in positive territory now, nearly all of them. They weren't earlier on. I can tell you, the CAC 40 there up 0.25%. One of the big talking points there, big French company, Air Liquide, industrial gases giant, nearly 6% higher in Paris after its full-year results came in ahead of expectations. Well, here in London, the FTSE 100 is keeping its head above water. Losses for the mining heavyweights are being balanced out elsewhere by gainers. The leading blue-chip gainer this morning, of course, Barclays, just been talking about them. Also reporting today, Intercontinental Hotels now 3.5% to the good. Another company reporting today in the FTSE is the Chilean copper miner Antofagasta. The share's up there nearly 3.5%. That's despite a dividend cut. Outside the FTSE, Mobico, which is the old National Express, its shares are down 8% on news of delayed publication to its annual results. But Domino's Pizza is up by some 5.5% nearly. That's after it received a push from one of the brokers. Lower down the corporate food chain, Superdry, up some 13% after Sky's Mark Kleinman reported its founder is courting the US investor Davidson Kempner with a view to a possible take-private deal. On the foreign exchange markets, the big story this morning is the US dollar is having a good session against the Japanese yen. Sterling unchanged against the dollar. It's off by 1/5% against the euro. Single currency, meanwhile, up a similar amount against the greenback. As for the oil price, it's drifted lower this morning but remains close to a 3-week high. Barrel of Brent crude will currently set you back $82.95 a barrel. That's off 0.75% nearly. Well, joining me this morning is Laura Fole, Portfolio Manager at Janus Henderson. Laura, good to see you this morning. While we've been on air, Andrew Bailey's been talking to the Treasury Select Committee. Quite upbeat, some of his comments.
It is quite upbeat, and I agree with what he's saying. So what he's saying is, we obviously had the GDP figures last week. They suggest the UK is in technical recession for the final 2 quarters of last year. But GDP figures are always backward-looking, and we've actually seen an uptick in recent economic data. To give you a few examples, things like consumer confidence, business confidence, real wages are back in growth. These things are improving from low levels. Consumer confidence has been very poor recently, but it is ticking up. So I think that the leading indicators, if you like, rather than historic indicators, are pointing the right direction.
Interesting. Now, I mean, the big corporate story today, of course, is Barclays.
Yes.
Jerry Del Missia, now, I thought some really quite punchy comments from him. What do you make of what they've announced?
So I agree with his comments. What I would say is, what I thought was missing was valuation. Barclays has been a very poor performer in terms of its share price and in terms of its valuation versus peers over time. Getting to a 12% return on tangible equity will not be easy, but the shares are nowhere near pricing in them managing to achieve it. I think that's always the context that you've got to bear in mind, whether it's through costs, whether it's through revenue growth. If they can get anywhere near that, that would be seen as a positive outcome, given where the shares are trading relative to book value today.
Yeah, as you say, all in the execution. Now, the big story yesterday, of course, was the takeover approach to Currys. You're quite worried about this.
I'm worried about it in the sense that I see UK companies being picked off. So we talk in the UK market at the moment about de-equitisation, in other words, the shrinking of the UK equity market. We've seen a number of bids, not just Currys, but a huge number of bids over the past 12, 18 months, often at valuations that aren't particularly heroic. Actually, I'd describe them as opportunistic rather than heroic. We've got to be careful about that because we're not seeing IPOs on the other side. In other words, there are takeovers, but there's nothing coming in the hopper for the UK market at the moment. So the market as a whole is shrinking. So it's not so much that I'm worried about Currys specifically, I'm worried about the fact that the UK equity market as a whole is shrinking.
But isn't that the fault of the investors? I mean, Currys is it's got £6 billion worth of annual sales, and it's valued at just a fraction of that.
So I really struggle with that argument because the UK fund management community as a whole can only manage the assets that it has. So if your fund is in outflows, you have to find that source of cash from somewhere. And you have a long list of potential companies that you think are attractively valued. It might not be Currys, it might be some of the other retailers. There's a long list of companies in the UK that are trading on valuations that you could very comfortably argue are low versus peers, low versus history. So I really struggle. I hear this argument sometimes, well, UK fund managers should have seen that Currys is too cheap. I think, well, we're only managing the pot that we've got. And there are a lot of companies that fit that mandate at the moment.
All right, Laura, got to leave it there. Good to see you as ever. Thank you. Still to come here on Business Live, is private equity the answer to the UK's lack of infrastructure investment? Don't go away.
I'm Helen Ann Smith. I'm Sky's Asia correspondent, and I'm based here in Beijing. My most memorable story was covering the extreme zero COVID restrictions.
A massive COVID wave is sweeping this city, but officially, almost no one has died.
This is a 4-lane dual carriageway, completely shut off. Some things are being allowed in, but actually the only thing we've seen coming out is an ambulance. The message from China is clear. This is a modernised military, absolutely able to fight an international war if needed. Is this military ready?
We are prepared to face every kind of challenge.
My biggest challenge is adequately telling the stories of the Chinese people, even when the authorities would prefer me not to. By the rules, we are allowed to film in the streets.
To the left, to the left!
I will always remember the atmosphere at the Shanghai protests. It was an electric mix of excitement, fear, and defiance, and a sense that history was being made. It's hard to express just how incredibly unusual these scenes are in China.
There are people who are afraid.
On the streets of Xinjiang, there is still a tension. Heavy police, a sense they're always watching.
It's really an incredible eeriness to this place, and it just is completely abandoned. The Chinese housing market, for so long a driver of growth, is now a real liability. We take you to the heart of the stories that shape our world.
It's actually hard to describe the cold here. It's so intense. It literally takes your breath away.
I can't tell if I'm moving it or it's moving me, but it's a very strange feeling.
The world is watching what's happening here.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, anyone who's used the UK's congested roads and railways or who's involved in the transition to net zero will know just how much this country needs more infrastructure investment. The UK government is keen to get pension funds to invest more, as in countries like Canada and Australia. But another source of investment could be private equity. Well, joining me now is Brett Himbrey. He's chair of Stafford Capital Partners, and he was previously CEO of IFM Investors, one of Australia's biggest pension fund managers. Brett, great to see you this morning.
Morning.
I mean, you think there's a big opportunity here in so-called secondary infrastructure deals. For the uninitiated, what are we talking about here?
In very short term, it's where an existing owner of a infrastructure fund, for whatever reason, wants to sell. So in this country, they're overfunded in their pension liabilities. They want to offload some of their unlisted assets in the form of infrastructure. That creates a secondary market for people like Stafford.
And why has the UK traditionally shied away from this sort of thing?
It's a really good question, and it's a very hard one to answer, to be honest, because the economics of secondary market investing, particularly in infrastructure, is very compelling. And in our experience, this is probably the strongest value we've seen in about 15 years. At the moment, only about 15% of infrastructure investors, asset owners in this country and around the world, are investing in secondary infrastructure. But the net returns that they're achieving, the lack of J-curve, the diversification benefits are really compelling. So the answer to your question is a difficult one to ascertain, but I think and can see it changing over time because the net returns to investors are so compelling.
I mean, traditionally, though, the hold period for a private equity investor is somewhat shorter than that of a traditional pension fund. Is that going to have to change?
It does have to change because, you know, investors want to minimise the exposure to what they call the J curve, where their money's not working for them. You know, that's costly. And frankly, that's an advantage of secondary investing as well. Often, you're able to get your money to work better. Now, you've got to make sure it's judicious and it's prudent and all that sort of stuff. But one of the advantages of secondary market investing is your money is working faster for you and for your working people that you're serving.
And logically speaking, I mean, private equity investors are used to unlisted securities. It's what they deal in.
Increasingly so. I mean, they've had a very strong position in this country and around the world to bonds and to UK and other equities. But pension funds around the world want to allocate more to unlisted markets, infrastructure, private equity, timber, and you know that trend continues.
Yeah, timber is one of the assets in which you're focused. Why do you like that as an asset class?
Well, the world needs more of it, and so the supply-demand dynamics are very compelling in that there's not enough supply. There's a huge amount of demand because of residential activity and also increasingly commercial activity. Plus, so the economics have improved dramatically. Plus, you now get a carbon credit. Plus, it assists funds in getting to their net zero aspirations. So the interest in that sector is growing for a whole range of economic and environmental reasons, but first and foremost, the economic reasons.
Now, the last time we had you on the programme, you were still CEO of IFM. I mean, you were doing for years and years what the UK government now wants pension funds to do in this country. Mm-hmm. Does it have a chance of that taking off?
Well, I think it's underway. I mean, firstly, in this country, notwithstanding some political uncertainty in this country and instability, generally speaking, the UK is a very attractive place for global funds managers like us and others to invest. So, you know, in very simple terms, I think the answer to your question is yes, because, you know, there's a rule of law here. There's a Westminster system. There's enforceability of contract. Private equity investors like us and others really value that. We'd like to see more policy stability here and elsewhere, but generally speaking, it's an attractive place to invest.
All right, Brett, I'm afraid we've got to leave it there, but it's great to see you again after all these years. Thanks for joining me.
Thank you.
That's it from me for the time being. I'll be back, of course, at 4:30 this afternoon with our afternoon edition, and hope to see you then. In the meantime, Kamali is up next with more on the news that we've just broken in this programme. Police searching the River Thames believe they have found the body of Abdul Azidi, who is suspected of carrying out a corrosive attack in Clapham, South London. We will have much more on that here on Sky News in the next hour. Don't go anywhere. I'll see you later. Cheerio.